Welcome to Breaking News to Trading Moves. Today, we're digging into a key piece of economic data from China. We'll look at what it is and then map out what it means for specific companies listed right here in the U.S. The goal is really to give you a clearer view of where some of the market pressures are coming from right now. So the main fact we're tackling is this. China's industrial profits, they surged 21.6% year over year in September. It's a pretty big number. It's actually the largest monthly jump they've seen since November 2023. And importantly, it's the second straight month of gains.
Yeah, 21.6%. It definitely catches the eye. But I think what's crucial for you listening is that this isn't just things bouncing back on their own. The numbers really reflect some very specific policy moves coming out of Beijing.
Okay, tell us more about that. The background material suggests this is quite policy-driven.
Absolutely. For a long time, the story in Chinese industry was, frankly, one of damaging overcapacity. You had these constant cutthroat price wars, everyone just trying to undercut everyone else, which, just crushes profit margins.
Right.
So the government specifically launched a campaign to try and rein that in, to curb the really destructive competition and get companies to, let's say, rationalize their output.
Okay.
That policy push, combined with something else important, easing producer price deflation, that seems to be what really lifted margins for these factories.
Okay, wait, let's pause there. Easing producer price deflation. Can you just clarify for everyone listening, what does that actually mean for a factory manager? Why is that so important for profits?
Yeah, good question. It's critical because it essentially stops the financial bleeding. Deflation means the price they get for their products is falling month after month. So easing deflation means those prices aren't dropping as fast anymore. Maybe they've even leveled off. And that difference, that margin relief, it gives these factories some breathing room. They can start thinking less about just slashing costs and maybe a bit more about efficiency or quality.
Ah, okay. So that distinction, moving maybe from just quantity and low price towards quality, towards efficiency, that seems like the main story here. And if Beijing is actually managing to sort of flip that switch, focusing more on productivity, well, that probably creates winners and losers right here on U.S. exchanges, doesn't it?
Precisely. If the incentive structure shifts towards quality over just sheer quantity, they're effectively nudging their manufacturers to invest in better equipment, not just more cheap equipment. And that's where certain U.S. companies potentially benefit. A more profitable Chinese industrial sector generally means stronger demand for, say, higher-end raw materials and more sophisticated equipment imports.
Okay, let's make that concrete then. Let's translate that 21.6% profit number into action. We can start with the U.S. sectors that might actually benefit from Chinese companies focusing on upgrading.
Right. So the first group that comes to mind is industrial automation and motion control. Think about it. When Chinese factories start spending again on capital expenditure or capex, often it's to replace older systems that might be inefficient or prone to errors. They might move away from basic, maybe cheaper machinery towards more sophisticated process control, more automation tech.
So this is about investing in technology that gives them more predictable, maybe higher quality output, which I guess ties back to getting away from those price wars you mentioned.
Exactly right. The policy direction kind of demands a better process, which in turn drives demand for things like U.S. factory automation systems, advanced drives, power management solutions, that sort of thing. So you might want to look at companies like Rockwell Automation, that's ticker ROK, also Eaton, ticker ETN, and Parker-Hannifin, ticker PH. These guys specialize in those precise, high-reliability control systems that are needed for this kind of industrial upgrade.
Okay, category 1, automation. Moving to the second group you see benefiting, heavy equipment and engines. Does this profit rebound mean companies like, say, Caterpillar, are suddenly going to see a flood of new orders?
Well, maybe not a sudden flood for like a massive new build-out, but it definitely helps support the replacement cycles. That's key. When Chinese manufacturers, and particularly those exporting, are more profitable, they have the capital and maybe the confidence to replace older machinery that might be costly to maintain. And we're talking construction gear, mining equipment, engines for power generation, things that need to be reliable if you want to keep a profitable factory running smoothly and meet your export orders.
Right, so the profit rebound gives them the financial footing and maybe the positive outlook to finally say, okay, let's buy that new excavator, whatever it is.
That's the thinking. That improved ability and confidence could translate into, some positive momentum for companies like Caterpillar, ticker CIT, also Deere, ticker DE, and Cummins, ticker CMI.
Okay. And what about the stuff that goes into the factories, the raw materials?
Good point. That leads us to our third potential winning group, copper and industrial metal suppliers. Even if the factory output is becoming more, let's say, rationalized or efficiency focused, it still needs significant inputs. And copper, well, it's often called the circulatory system of industry, right? So an upturn in manufacturing activity, even a quality focused one, tends to tighten up copper markets. It drives more smelting, more fabrication. This could create a more positive environment for U.S. listed copper producers. Think Freeport-McMoRan, ticker FCX, and Southern Copper, ticker SCCO.
Okay, so that covers the potential winners. Companies supplying the automation, the heavy equipment, and the key metals needed for China's industrial upgrade and efficiency push.
Yeah.
Now let's flip the coin. If Chinese factories are running more efficiently, more profitably, who in the U.S. market might feel some pressure from that?
Right, and this is where it gets a bit paradoxical. The same stabilization that might help, say, U.S. automation firms could potentially hurt U.S. commodity producers. The first category here that could face headwinds is U.S. steel and aluminum producers.
Why is that? If Chinese domestic demand is maybe stabilizing or their factories are more profitable, wouldn't that just absorb their own output?
You'd think so, but the legacy of that massive overcapacity in China is still very much there. Even with better margins domestically, their mills are often capable of churning out way more steel or aluminum than China itself needs. So if those mills are now profitable and running efficiently, it's quite likely that export flows will increase, or at least remain high. And that extra supply hitting the global market weighs on global prices for steel and aluminum. Even with U.S. tariffs in place, that global price pressure still impacts profitability forecasts and, demand expectations for U.S. companies.
So in a way, they end up exporting their improved efficiency, but also exporting their overcapacity problem at the same time.
That's a good way to put it, yeah. So companies potentially feeling this pressure include Nucor, ticker NUE, also Alcoa, ticker AA, and United States Steel, ticker X. Their operating margins can get squeezed when there's cheaper supply sloshing around the global market.
Okay. Second category, facing pressure. This one seems quite specific and very sensitive to Chinese capacity. U.S. solar manufacturers and inverter makers. China's dominance and, frankly, overcapacity in solar manufacturing is, well, pretty well known.
It is. And that overcapacity issue can actually be amplified by profitability. If Chinese solar factories are profitable and running hard, they're incentivized to ship even more components globally. Panels, cells, the works. And this sort of relentless supply keeps downward pressure on module and component prices everywhere, all around the world. That creates a real challenge for U.S.-listed competitors, especially those maybe focused on domestic manufacturing or trying to sell higher-margin components like advanced inverters.
Yeah, we've certainly seen that dynamic play out before. Chinese manufacturing scale often sets the global price floor for solar. Which U.S. firms are most exposed here, do you think?
Well, you'd look at companies like First Solar, ticker FSLR, also Enphase Energy, ticker ENPH, and SolarEdge, ticker SEDG. Even if they make sophisticated products like microinverters or power optimizers, if the core panel price keeps falling due to Chinese supply, it puts pressure on their overall system economics and their own profitability.
Right. Okay, and finally, let's talk basic materials. Commodity petrochemicals. What's the dynamic there?
It's somewhat similar to steel and aluminum, actually. Increasing Chinese output in basic chemicals adds supply to the global market. Think about, the building blocks for plastics, basic industrial chemicals, that kind of stuff. When China ramps up efficient, profitable production and exports more, it directly pressures the operating margins for U.S. commodity chemical producers who sell into that same global market.
So again, it's hard for U.S. firms to maintain premium pricing or even just stable pricing when the global market sees a wave of lower-cost output coming from China.
That's basically the challenge. Yeah. U.S. producers might find themselves needing to, say, run their own plants at lower rates just to manage inventory and avoid selling product at very low margins or even a loss. Companies that operate in this space and feel this pressure would include names like Dow, ticker DOW, and LyondellBasell, ticker LYB. So if we try to boil this down for you, the main dynamic seems pretty clear. You have this improvement within China's industrial sector, driven by these specific policy goals, trying to rationalize things, curb that destructive competition, and that has these contrasting effects on U.S. companies. On one hand, it could boost demand for those supplying productivity tools like automation and maybe heavy equipment. But on the other hand, it can intensify the competitive pressure on U.S. producers of global commodities, things like steel, solar components, basic chemicals, because they're sensitive to that overflow of efficient Chinese production hitting world market.
And it really does seem like this whole picture rests on whether Beijing's policy efforts continue to work or maybe how well they work. That central issue Can the government really steer the industrial sector away from just price wars towards focusing on quality and sustainable profits? That seems like the key thing to watch, because the success, or maybe the failure, of that specific policy effort is probably going to keep influencing these kinds of market movements globally for quite some time.
And just to be clear, this analysis is not financial advice or a recommendation to buy or sell any security. This discussion is purely the opinion of the author of the provided material.